Great. Thanks, John. So I guess we have 45 minutes. This is going to be divided into two parts. I'm going to give like a bit of a high-level overview for 15 to 20 minutes, and then I'm going to pass the baton to Nitin Kohli over there, who's going to present like some preliminary research results. And there'll actually be another talk tomorrow by a student named Suraj Nair that will build on some of what we're talking. Just to provide a little bit more, I think you got the sense from John's talk that there's like a lot of interesting data that's enabling and underlying a lot of innovation in digital credit. And I'll sort of make the point that it's also enabling innovation in financial services and fintech more broadly. But where is this data coming from? I think it's worth pausing for a minute just to highlight. Again, I think most of the people are going to be familiar with just the rapid adoption of mobile technology in low and middle income countries. These stats, it's a little bit hard, you know, it depends who you ask. The International Telecommunication Union has stats that are almost double what the GSMA says, which is a industry group, but very high rates of both mobile signal coverage and household level mobile phone penetration. And very rapidly increasing rates of smartphone penetration, even in very low income settings. So what you're seeing is, on the one hand, you have the massive proliferation of digital devices, and you see the overlay of financial services, the most prominent, even before you get to digital credit, being mobile money, where, again, I think most people in the room are familiar with this, but the idea is not that you have a mobile banking app that's connected to your brick and mortar bank account, but rather you have basic financial services that are facilitated by the mobile phone network, right? So most people have pay-as-you-go accounts, often on just the candy bar $10 phones, no like a feature phone, no touch screen or anything like that. And you would load balance, you would go to guy on the corner, put down $2 or $5 for a scratch card. You would then load the balance onto your phone. And at that point, your phone functions like a basic debit card. So you can use that money to purchase goods over the counter. You can use it very commonly to buy airtime, to then make phone calls, or you can transfer it to someone else. So that was sort of the first suite of mobile money services. But what you see now is the rapid expansion of more innovative use cases like digital credit. And so I think this is very exciting to a lot of people in the development community, because you see huge numbers of people, billions of people globally, that don't have access to a bank, but they do have access, or they do own a mobile phone. And so if you could think about having, you know, what's 2/3 of 1.7 billion, a little over 1 billion people who have a phone and could potentially be provided financial services for the first time because they wouldn't have access to it through some other mechanism. And so John talked a little bit about digital credit. I want to also use this opportunity to answer one of the questions that came up. What's going on behind the scenes is that digital credit is, as I have here, transforming the consumer credit landscape. And you can see some of the adoption numbers on the slide, and some of the products and services, their advertisements. Part of why they're able to do this is because they're able to leverage new sources of personal data in order to build alternative credit scores that are then used to facilitate lending decisions. So, you know, historically, you have an unbanked individual, it's very hard to originate and service the loan just to get them the money and to collect their payments. But if they can do that using mobile money, that sort of solves that issue. The second thing is there's the adverse selection, there's these information asymmetries where you don't know which among these people who don't have financial transaction records or formal histories are good credit risks versus bad credit risks. And so what a lot of these companies have discovered, and I think really Mshwari in Kenya, which was launched by Safaricom in the late 2010s, I don't know if you know the date, but I want to say like circa 2015, 2016, they realized that the data that the mobile phone companies have about how people are using their phones and transacting in mobile money can be used to construct a credit score. So again, to the question that came online, the basic idea is you make some loans to people, and these are relatively small loans, $5 or $10. You then see who repays those loans, and then you basically use data that's collected on the phone and machine learning algorithms, artificial intelligence, to try and predict loan repayment. So the idea is that the people who are more likely to repay their loans look different in their data streams than the people who are less likely to repay their loans. I'm going to make this up, but you might imagine that people who have large mobile money balances on their phone are more likely to repay, or the people who are making a lot of international calls are of a different wealth, in a different income bracket, and are therefore more likely to pay. Or it might be the opposite. Again, it was very likely going to be context specific. But driving these products, especially digital credit, is the availability of large-scale personal data, typically coming from phones, and machine learning algorithms that are able to learn these decision criteria based on patterns that exist in those data streams. And so what do the data look like? I have here example, this is a data set from a mobile phone operator in Afghanistan. On the right is data from a Latin American country. Again, they're mostly data that are generated and held and controlled by private companies, phone companies, or other services that are built on top of it. But you have very, very rich data on, again, not just financial transactions like mobile money, but the social network structure of individuals, who they're talking to, when they're making phone calls, if the calls are local, domestic, international, and so forth. And again, when you apply machine learning algorithms, you can extract a lot of useful information that can be used to build these apps. A project that will come up tomorrow is trying to think about how you might use these data. So again, everything I've talked about so far with digital credit is how do you extract the most signal from that data in order to maximize profits for a financial institution, right? Basically build an accurate credit score that will ensure that your default rates are as low as possible, which allows you to, reap in money, but also potentially originate more loans. But you could flip that on its head, and that's what this talk by Suraj tomorrow is going to be about, which asks the question, well, we have all of this, we're beginning to have a lot of information and evidence now on the welfare impacts of loans. Are they helping people's mental health? Are they helping people smooth consumption and so forth? Well, there's now innovations in machine learning that allow you to say, well, how accurately can I predict whether a given loan applicant is likely to benefit or not from a loan? Just like we can predict ex ante whether they're going to repay their loan or not. Well, if we could predict whether or not they're going to benefit, and John highlighted already how there's very heterogeneous impacts. Basically, some people benefit and some people don't. Well, if you had foreknowledge of that, maybe you could target loans to the people that are most likely to benefit, as well as the people that are, very likely to repay their loans, in order to maximize consumer welfare, not just private profit or some private objective function. Okay, so I've talked a bit about credit, but I'll also point out that the same idea, new data, new technology, is also beginning to transform other financial sectors, including payments, insurance or insurtech, pay-as-you-go markets. Paul Gertler, I'm not sure if you're talking about that project in the next day, but has work on these pay-as-you-go markets. And again, the data is really critical to enabling those sort of product innovations. And I'll also, as a footnote, mention here that while today and tomorrow are really focused on the financial sector, the same paradigm is really transforming a lot of other sectors that are very relevant when you're considering the welfare of populations, particularly in low and middle income countries. I have a project where we show that the same exact alternative credit scoring technology can be used to estimate whether individuals or households are below the poverty line, and you can use those estimates to target humanitarian aid to the neediest households. And we did this project in Togo. But likewise, you're using the same data or similar data and technology to provide agricultural advice, to provide agricultural insurance and other products. Okay. Now, I think the last few slides really paint a picture of why people get excited about the potential and promise for these new technologies and new data sources, and the fact that you have billions of people using phones that don't have access to financial services. But I think there's also like the dark underbelly of this innovation. And you see a lot of concern, and this is very salient, I think, here in Berkeley near Silicon Valley, of concerns of data privacy. And basically, at what cost to personal privacy are we enabling these new products and new innovations? So the other scientific director of the initiative that Carson mentioned. Rediat Abebe is a professor here in computer science at UC Berkeley, has done a lot of work on sort of issues of data access and data empowerment and who really controls the data. And as you may imagine, there are concerns of some of the terms you see of data colonialization or surveillance capitalism, that basically it's really the private companies that are extracting all of the benefits from having access to new data and new technology. And the consumers themselves really have no say in how their data are being used or how it's being analyzed. Of course, in places like the US, you would assume that regulators would play a big part in ensuring that consumer protections are enforced and exist and so forth. But what you see, at least historically in a lot of low and middle income countries, is that such regulations either don't exist, or if they do exist, they're never enforced. And so it's been a bit of a wild west of data access and data privacy, where historically it's been up to the companies themselves to self-regulate what data they collect and how it's being used and how they're transferring it and sharing it. That's changing rapidly, and in part because you see that, again, if the ecosystem is being facilitated by the mobile phones, then a lot of the product ecosystem is being facilitated by the app providers and the app stores, like the Google Play Store or the Apple App Store. And so what you see is really profound shifts in product technology that coincide with when the app stores make changes to their privacy policies. So for instance, I think it was in 2020 that the Android store or the Google Play Store restricted what data could be collected by all apps, and basically stop the app developers from collecting information on call histories and SMS networks. And this basically torpedoed a bunch of the, I can't remember which column it was in your slide, John, but a lot of these app-based financial product, fintech companies that were providing digital credit. And so they had to totally, and without a lot of notice, pivot their product market and the way they design their product to cope with this change. And so I think, you know, the companies operating in this space like stability, and right now it's extremely unpredictable. Countries, so like some countries are saying, well, they're going from having no privacy legislation or regulation to adopting GDPR, which is a very rigid and restrictive set of privacy regulations. And so, you know, that totally distorts the sort of products that might be available or enabled. And so, you know, I think when we as researchers step back and look at this, there are some really important questions and problems and potential solutions that I think we think need further exploration. So I've listed a few up here. I'll just sort of highlight them briefly. I think at a very foundational level, there's an important question about just defining data privacy and elucidating what are the data privacy concerns in these contexts. Because I think right now, a lot of the people that are thinking about data privacy in these contexts are saying, well, let's just take the data privacy paradigm that's coming from Silicon Valley and, you know, industrialized nations and just slap it onto the applications that are existing in a lot of emerging markets. And I think for a lot of reasons, including qualitative research that's been going on in the last couple of years here at Berkeley, there's good reason to think that the fundamental concerns that people on the ground have in, say, a rural village in Africa or even an urban setting in Nairobi are just fundamentally different than the sort of concerns that are very top of mind to the Googles and Apples of the world. So just getting a more comprehensive understanding of what those concerns are, I think, is really important. And then second, falling out of that, to what extent can the existing set of privacy-enhancing technologies actually address and protect those concerns? And this is something that Nitin will talk about in a minute, so I won't say too much about it. But by that, I mean things like differential privacy or homomorphic encryption or secure multi-party authentication. Again, a lot of these things that have been really popularized over the last 5 to 10 years in industrialized countries may be very relevant to applications like digital credit, but to sort of spoil what Nitin's going to say, what you see, and this jumps down here, is oftentimes there's a lot of, there are really important trade-offs between increasing consumer privacy and other objectives that you as a regulator or as a company might care about. And so I think very intuitively, the more, like, let's just think about that credit score, right? You have a credit score that's using private data, and a good credit score will be very accurate at predicting whether or not someone's going to default or not. And a bad credit score will be not very accurate. And an accurate credit score translates directly into, you know, the sustainability of the product ecosystem. So I think every company would say, sure, I'd love, all else equal, I'd love to maximize the data privacy to my customers. But what Nitin's going to show is that there's a very clear trade-off. The more private the data is, or basically the more noise you add to the underlying data that's being used to generate a credit score, the less accurate the credit score is going to be. And we see the same thing in the humanitarian aid setting, where when we make the underlying data coming from people in rural Togo more private, then our ability to target cash transfers to the poorest people in Togo is inhibited. And so this creates a trade-off between privacy and accuracy that is really often hard to navigate. But privacy is just one example. Like transparency is another, or welfare is another. Like the project that I mentioned earlier that Suraj is going to talk about, it's going to be harder to predict who's going to benefit from a loan if the underlying data is privatized, just like it's going to be harder to predict who's going to default on the loan if the underlying data are privatized. So, you know, I think we're generally aware that these trade-offs probably exist, but to our knowledge, there really hasn't been any rigorous research, either, especially empirical research, documenting how big are those trade-offs and where, you know, what do the Pareto frontiers look like, and where might a private firm operate along that frontier? And then, you know, the last point that I didn't mention here is I've talked a lot about technical approaches to maximizing privacy, but of course there are a whole suite of non-technical approaches like user interface design, or consumer, you know, providing better information to consumers on how products work, or regulatory mechanisms and so forth. So, you know, I think the fact that those questions are so salient in our minds. Oh, and I should have mentioned briefly, can I go back on the slide? There we go. With funding, generous funding from IBSI and Ripple, Impact, I think it's called, and Binance, we're working on a white paper to basically try and lay out a research agenda around the space, and hopefully that will be out very soon. Basically just not answering any of these questions, but posing slightly more eloquently what we think are the most important questions in this space. But in the meantime, the SIGA, with support from DCO and the Bill and Melinda Gates Foundation, just recently launched, I think a couple of weeks ago, Dan, and Carson mentioned this briefly, sort of an initial request for proposals around some of these ideas. And the objective behind this RFP is, one, to enable continued data use innovation in fintech. And then two, I think because right now, a major impediment to innovation is the inability of different companies to share data with each other, or with researchers like us, or with regulators, because of the concerns around privacy. If you could think of ways to privately share data and facilitate different product innovation, I think that could be really, could unlock the next generation of these products. And then finally, just to make sure that, unlike a lot of what you see at like Facebook and in Silicon Valley, is very reactive to major privacy scandals that are very, you know, salient in the media, to really get out ahead of these issues, so that the next suite of applications are, you know, proactively identifying and addressing these potential threats. So I think that's pretty much all I wanted to say. You can find this online. I just wanted to highlight the initial deadline for this RFP is June 22nd, and from then, after then, it will be rolling. But okay, I've talked very abstractly about some of the big issues that arise. I think the plan for the next 15 minutes or so is to transition to Nitin, who can give you a much more concrete example of what this sort of work, or what one version of this work might look like. Okay, thanks. And I guess I'll come back at the end if there are questions as well.
All right, thanks, Josh. So if we're going to consider what data privacy in emerging markets would look like, I want to actually pause for a second and actually just consider what this word privacy could even mean. Because we're going to talk about it as data privacy and then data privacy in emerging markets, we should probably start here. So any ideas from the audience? Let's make this a little interactive here. There are really almost no wrong answers to this question. The right to be left alone, I heard from Dan. That's a conception of privacy. That's pretty common. Yes. Any other brave souls? I can just continue if not. I like control over your own information as well. Thanks, Carson. In fact, right to be left alone and control over information are two of the very common privacy paradigms we see, at least in the United States and the European Union. But I actually want to dig deeper in this for a second here. So some common answers to this, Dan and Carson mentioned a few, but oftentimes when folks are asked, what does privacy mean? They'll appeal to literary or cinematic fiction. They'll draw upon certain metaphors that they've seen before. For example, George Orwell's 1984 about worries about the surveillance state. They'll sometimes draw upon Kafka's The Trial, this bureaucratic nightmare induced by the dossier society. Or they'll go really predictive policing and talk about the Minority Report. But even with these three things here, we see these three metaphors that are imposed actually address very different privacy concerns. Let's hold on that thought for a moment. And then there are also one-line responses that folks will often say. The right to be left alone, as Dan mentioned, is a very common one. Control over information is another common one. Sometimes people will say privacy is all about secrecy, kind of drawn upon cryptography and early internet work. Other times, folks will say it's about consent and respect. There we go. Other times, folks will say it's about limited intrusion upon your body, your actions, your thought. So really tying it back to the individual. And I can make a big long list if I really wanted to here. And one thing I want to kind of point out is that these are all perfectly valid conceptions of privacy, and they all address very different problems. And the main moral is that these are particular conceptions that were meant to address a particular social issue at a particular point in time and a particular place in time. So let's kind of go down this little history example in the United States. At the end of the 1800s, the United States saw the advent of this camera here. Well, not this camera, but cameras in general. But at the same time, they saw proliferation of newspapers and publishing in general, which allowed individuals to then capture intimate moments that were once fleeting in time and only constrained to those in the know-how and place and distribute them more generally. Kind of our first information disclosure mechanism here. There were a few folks who were very good lawyers. One of them actually became a Supreme Court justice who found this to be very, 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 very problematic. He was a little concerned about the ability of folks to take pictures of his daughter's wedding, put it in a newspaper, and then have it dispersed for the whole world to see. This actually then led to a law review article, no joke, called The Right to Privacy, published in 1890s by Warren and Brandeis. So this notion of the right to be left alone comes from this law article that was really talking about the dangers of photography and the information mechanism of newspapers. Yet we still hold on that today very, very tightly. Now let's fast forward a few years to the 1960s and 1970s. Around this time, there were lots of efforts to have government record-keeping systems to help the administrative state function. But the 1960s were pretty turbulent. There was a lot of distrust in government at the same time that these record-keeping systems were being put in place. For example, Nixon's Watergate scandal. And fueled by this public distrust of what the government could do with record-keeping systems, a report was commissioned that was eventually called The Records, Computers, and Rights of Citizens that sought to, I guess, mitigate the privacy concerns about secret surveillance systems. And they said the way to do this is to make sure individuals have control over their information. So that's where this notion of privacy comes from, very distinct from the previous one. But also at the 1960s and 1970s, there's a parallel privacy story going on that has often been lost, except for maybe in the past month or so. And that's actually that privacy used to be really tied to reproductive rights at the same time. There was the famous Griswold case that allowed for married folks to use contraception absent government intrusion, because that would essentially, in some ways, limit the ability of a couple to make decisions absent intrusion. That was a bodily privacy concern that the courts were concerned about. This manifested even more in cases with Eisenstadt afterwards, and the famous Roe v. Wade case about bodily autonomy and decisional privacy more generally. But with these court cases, there was a few privacy scholars, particularly those who were conservative, that thought that privacy had overstepped its bounds, that privacy should be defined solely as control over information. And that narrative has stuck to this day. That is how we ended up more or less with the dominant discourse of privacy is about controlling information, which then severs it from the human being itself. Now, by going through this brief history lesson, there's something kind of interesting here. Right? Like these things that all came up were in the context of US history. And these might not be the same things in emerging markets or in low and middle income countries. For example, Rediat Abebe has this paper in which she actually notes exactly this. For example, one thing that's very common in the United States that we're quite okay with is the sharing of aggregate statistics, because we typically believe those tend to have less privacy problems if I compute over a bunch of people. They're not immune from privacy problems, but they tend to have less. However, in some parts of Africa, this is considered to still be a privacy violation. The fact that you share any information about my community with individuals outside the community. So this shows that some of the intuitions and priors we have about privacy might not actually transfer. And that's expected, right? Our notions of privacy are rooted in what we've seen through our history. And this is a fundamentally different place. So in order to not be like completely lost in the woods, it's probably a good idea to not try to have a universal definition of privacy here. And that's kind of tough for me to say. I'm a mathematician. I love my very precise definitions. But if we're going to actually solve privacy problems, we have to do what all those definitions did in advance before. They addressed the particular socialism issue at the particular place and time that was relevant for the region they were in. And one way to do this that we'll actually unpack in the following example is to just straight up answer the who, what, when, where, why, hows of privacy. Sometimes much of our solutions get caught up in trying to be too grand and too abstract, but let's actually be concrete and just solve the problem we have. So yeah, different privacy problems may need different privacy solutions, sure. So I want to actually focus on this case that Josh actually set up very nicely for me, so I might go through this slightly quicker. Let's say we have a phone company with vast troves of mobile phone data. And we know that there are institutions such as governments, banks, and so on that can do socially beneficial things if they had access to this mobile phone data. So we'll say we live in a world where an analyst, say at a bank, for example, is actually able to get access to this mobile phone data to predict whether or not an individual is creditworthy. We can actually take this exact framework and change the bank for a nonprofit or a government to help predict poverty, for example, or to help predict where disease spread is going and so on and so forth. But let's just stick with the credit scoring for now to make it completely concrete. While this is great and all, there's actually a sharp line that's drawn that typically doesn't facilitate the transfer of mobile phone data. And let's think back to the who, what, when, where, why, hows of privacy. I have this mobile phone right here, and it follows me around every day, kind of like an ankle monitor. It knows exactly where I am. It bounces off towers, giving the general location of where I am. It kind of knows, who I'm texting at what points in time, where I am at 2 a.m., for example, and many other concerns. So for this reason, we would like to hope that instead of actually giving over data that's particularly sensitive, what if I could give over instead a private data set? And I want to kind of make this a bit more concrete. I want to preserve a lot of the statistical characteristics I see in this mobile phone data set, but try to snip off the sensitive parts of this that might allow for you to learn too much about me. If we're trying to predict whether I'm creditworthy or not, I probably don't need every single attribute that's actually a mobile phone could collect. And when I say private, I don't mean just like, let's remove zip code or my name or anything. Those are actually very easy to reverse engineer and really easy to break. I want things that are provably private, meaning that we can write down a mathematical proof beforehand, letting us proactively know that not too much information will be leaked about me if data is shared. And if that seems pretty abstract, I'll make it make more sense in a bit, and feel free to pepper me with questions all during the Q&A. This is the goal here. Can we create a private mobile phone data set that still allows for accurate credit score predictions, but alleviates a lot of these privacy concerns about sensitive information and inferences we can draw from the phone data? So one way we do this is typically what's something called differential privacy, and Josh actually laid this out very nicely. So there's this trade-off between privacy and accuracy that exists. If I inject no noise into the data set, you can perfectly predict with that data set, no problem at all. Well, let's say I tried to create the most private data set in the world. One way to do this, which I don't recommend, is to just ignore the mobile phone data set altogether, sample noise from some distribution, and just give that to the analyst. There's no real data in there, so there's no privacy problem, but that is going to in no way build a reasonable credit score model. So what we want to do is, rather than thinking about privacy as a binary, you either have it or you don't, think of it as a spectrum in between. How can I leverage the mobile phone data I have and very carefully calibrated noise, intermix those together to still allow for reasonably accurate predictions for credit scoring, while alleviating a lot of the privacy concerns we may have from the facilitation of mobile phone data being transferred. And this typically shows up in the mathematical literature with this fun symbol epsilon here. That's a knob. It allows us to control this privacy accuracy trade-off. So in the case of credit scoring, we might think about this as profitability as being served by accuracy. In the case of humanitarian aid, accuracy helps promote welfare. So accuracy is this statistical concept that we can measure, but it really extrinsically serves other social things that we're more concerned with. And one thing we find is that we can actually reasonably, with very preliminary results so far, create private phone data while still preserving quite a bit of the accuracy that we want to see from these predictive models. So let's forget the x-axis right now and kind of just look at the far right line over there. There's this purple curve that says a non-private credit score. This is the data in the clear, no perturbations added whatsoever. And using 20 features, we're able to get roughly 68% accuracy with this model. Now let's look all the way at the very bottom with this very private credit score using a very small epsilon, so it has a lot of strong privacy guarantees. We see that we're able to get roughly around 63.5%, even when we purposely add noise in the data to provably guarantee, quote unquote, bad things can't happen. But the nice thing about differential privacy is that epsilon is a knob. So it actually creates a spectrum of curves that we could draw in between. And the fact that we have a spectrum here allows us to, for the first time, facilitate how companies and policymakers can determine the level of privacy and accuracy they want to serve the needs that they need at the same time. Of course, what's the purpose of creating a credit score if it's not useful? What's the purpose of giving humanitarian aid if it's not going to be effective? So the fact that epsilon is this knob that can allow policymakers and companies to tune is going to enable a lot of new provably private solutions to be deployed in practice here. Now, if we actually look at the x-axis here, there's kind of an interesting story. We notice that for everything except the purple line, these curves kind of tend to go downwards. And at an intuitive level, this captures the idea that if somebody collects more information about you, you must get more unique. The more I learn about you, the more I know about you in general. So in order to actually privatize large data sets, that's a very tough problem. But for parsimonious models, we can actually privatize these reasonably well. So a lot of the work we're doing right now is kind of trying to figure out how to squeeze this blue curve and purple curve together. Can we actually close this gap between the privacy accuracy trade-off? And it's unlikely to be the case that we'll be able to perfectly slap them together. They're not going to be completely sandwiched. But that then lets us know a hard trade-off that must exist, that which we can actually then navigate socially. So a summary of what this is, using real data from Togo, we can actually document for the first time the empirical trade-off between privacy and accuracy in a real-world system. And like I said before, we're currently trying to figure out how to better optimize this by squeezing those blue and purple curves together to kind of see what's the limit and what we can get. And what's really interesting is this actually shows one way in which we can effectively leverage privacy-enhancing technologies to address these threats proactively. This wasn't like a data scandal that happens afterwards, so then we added privacy in. We thought about this from the beginning, and because of the mathematical guarantees of this notion, they kind of disseminate afterwards as well. So the big picture of all this, right? Big data is being used to enable lots of financial technologies. And this big data is almost by definition personal, yet so it must be private. But in many places, data privacy is an afterthought if it's really considered at all. But this shows that one way that we can actually do this is to leverage existing techniques and know that they might not be perfect given the fact that we're in the United States. But by expanding our notions of what privacy is in other contexts and how these tools are used, we can actually appropriately leverage these to actually enable long-term success of these platforms. And I finished just in time.
Hi, thanks, Nitin. Great presentation. If you zoom out on your graph and have a 0 to 100 scale, I just want to make sure I'm reading this right.
Yeah, give me 1 second. I'm trying to figure out how this backwards button works. Yeah.
Isn't it already pretty tight? I mean, aren't we within about 4 percentage points there?
Yeah, so so I guess this is a function of how tight can we get. So I have a feeling that by more optimization techniques, I can actually squeeze this down probably a bit further.
But might you not also conclude that it should be easy to convince a provider or a collector or a credit evaluator to semi-privatized or privatized data because they're essentially getting a comparable result?
Yeah, so in this case, if we think that for like their profit, for example, that there's not too much of a deviation between the 64% accuracy and the 68, then that's the case. It may, of course, vary from institution to institution. So at least like from a theoretical standpoint and an empirical standpoint, it's kind of, I'm at least interested in trying to squeeze this gap, but I take your point well taken, actually, that if we zoom out, this is actually a pretty narrow band.
My question is about the general consequences of moving to a world in a way of kind of like a first-degree price discrimination in which everyone is going to get an interest rate and a loan amount that is specific to the risk profile versus a world in which there is some pooling in equilibrium. No, if there is some pooling, there is some subsidy from the good credit risk to the low credit risk, especially for the ones that are getting credit now. And as we move towards this world in which we can perfectly split the average credit risk from into good and bad, there may be some redistributional consequences with some people that were before being subsidized because they were pulled together, now end up getting kind of like higher interest rates or lower loan amounts. I don't know if you guys have any thoughts on this trade-off between this targeting and kind of like moving to a world of first-degree price discrimination to a world in which we are today, in which there is some level of pooling.
Sure. Yeah, I think that's super interesting. And I think one thing you see, and you can see it here, is that privacy might also, like if you think of the pooling as some sort of externality that's generated by making the credit scores a little bit less accurate, then I think the idea, and this is something we've started to explore, is right, like Nitin's focused on this one metric, which is accuracy. And also to your point, like 64, 68, who knows? I think what really matters is to then layer on some sort of objective function over this accuracy. So we say, okay, well, if we're a private firm, and this is the ecosystem in which this credit score gets fed into, what are the actual implications to like P&L of 64 versus 68? But you might see something sort of surprising, which is that because if there is this sort of externality where you're able to, subsidize the bad credit risk with the good credit risk, it may be that actually the like total return on the 64% might actually even be better than you would think. And that's one example. If we then think about the example of a humanitarian aid distribution, again, you need to have some notion of what the government or the social planner is trying to optimize, because they're not trying to optimize accuracy. Like in typically with humanitarian aid, they're trying to maximize or minimize errors of exclusion, right? Like the truly poor people that are prevented from getting the resource that they should have. And so again, that requires taking one step back and like wrapping around this a more like concrete framework about how you sort of what the costs and benefits are. But I think those are both excellent points.
I think there's another dimension here besides privacy and accuracy, which is bias. And this is going back to the question that came through earlier. Can you guys talk a little bit about whether there are any studies from the DCO or maybe aspirations to conduct research on the effects of bias and how to minimize it?
Yeah, I mean, I can say something, and maybe you want to comment as well. I'm not aware of anything in the DCO 1.0 that explicitly looked at bias in the sort of like machine learning conceptualization of bias. Almost every study did look in particular at gender and the extent to which credit products were helping or harming women relative to men. But I think, this data privacy call is really focused on this question of like privacy, but you can sort of see over here, right? Like privacy is one thing you want to optimize for. Profits might be another thing you want to optimize for. Transparency might be another thing you want to optimize for. And I think fairness is another. And I think there is a pretty robust literature now that's documenting the trade-offs between fairness and things like accuracy. And, as you might expect intuitively, the accuracy maximizing credit score is going to have fairness implications that we as a society may not be comfortable with. And so then I think it goes back to the last point, like how does the total ecosystem prioritize and balance objectives related to profits versus fairness versus privacy and transparency? But I think what we're working towards is a quantitative framework that makes it more visible to the policymaker or the institution or the bank, like what the levers are that they can, like that epsilon knob that Nitin illustrated, so that they can at least know what the implications are of making one decision versus another. Did you want to add anything?
I can wait.
Glad you agree. So the emphasis where you guys are going to try and provide individual welfare weights to get some sort of welfare function out of these things illustrates an issue with using these average or accuracy outcome measures, which is the portfolio of who you're picking is going to differ across these algorithms as well as the accuracy. And without these weights, you can't ask, because you may get the same level of accuracy, but a very different portfolio. And that difference in portfolio might create, because of the heterogeneous impacts, which Josh is working on anyway, will end up with different welfare outcomes, whether that be profits or targeting the poor or things like that. And it'd be nice to see a picture like this, which said, okay, now let's weight the profitability of different types of people and see the accuracy profitability trade-off. Because it may be that you have the same accuracy, but the portfolio choice will end up being very different and very strongly different welfare implications.
Yeah, no, I think that's a really great point. And you can take it one step further in the sense that once you have that framework layered on top, whether it includes like welfare weights or something different, you can then think about how you can optimize it through the actual machine learning process, right? So right now, all these algorithms are, say, trained to minimize or maximize accuracy by minimizing missed predictions. But there's no reason why you might not build those welfare weights into the actual objective function that's used to train the machine learning algorithms. So we say, well, we don't actually care about accuracy in this population, but we really want to prioritize accuracy of predictions in this population. And again, that can sort of like feed back into this entire frame. I think it's a really good point. Yeah.
Okay, maybe this is an unfair question, but it's been a little bit gnawing on me, which I think is like what, for example, is like from a policy perspective, we might do with case studies like this, because I would just conjecture that this is going to be very application specific in terms of like the country and the types of features and the problem that you're trying to solve. But like, I guess in my mind, maybe, the end goal would to sort of say, okay, Google or whoever is the gatekeeper is going to add noise or not release a certain set of features, and then people can kind of play with this thing that we think is like reasonably private. But then how do you it's like, then how do you ever know if you're kind of in a happy case study like this? Or I could imagine some fintech company could do their own case study and say, hey, the trade-off here is really enormous. It's very important that we have access to all this sensitive data. Like, is that something that you've begun to think about? Or maybe what's the vision for how these types of exercises could like inform more systematic policy thinking?
Yeah, I mean, I'll have like a first couple of steps, and I'll also let Nitin chime in. I mean, I think really first order immediate term is just to surface a set of policy instruments that don't yet exist, right? Like we can show you that knob, that like epsilon knob, and it makes intuitive sense to people. But I think, and including the partner that we worked with on the impact evaluation that John mentioned, the Bjorkegren et al. Study in Nigeria, right? Like they were interested in this approach, but they really wanted to know, like, but what are we talking about? Like, how much higher are our default rates going to be? And I think you're absolutely right that like having an N of 1 is not going to answer their question, except that we're using their data. So for them in particular, it will. But for a lender, like a bank-led lender in Malawi or something like that, that N of 1 from Nigeria may not be so relevant. But at least it like begins to chart out what that like multidimensional space looks like. And I think the hope would be to like populate it and to make it easier for, like with the stuff in Togo, we put out like an open source library. So in theory, it's a lot easier for some other organization to like run their own experiments and to calibrate it to their own data. Now, I think that's a pipe dream in the short term, but I think in the long term, just to like, and in particular with this seed funding through the Gates Foundation for this data privacy RFP, is to just like raise awareness and try and bring in like computer science researchers who understand privacy, like Nitin, to work with people like us who understand the economic situation, but don't really know to what extent that those privacy security mechanisms might be relevant. It's sort of a hand-waving answer, but do you have something more concrete?
That was actually exactly what I was going to say. Part of the issue, at least with some of these tools, is that when we discuss them in like the theoretical computer science literature, is that we often give like worst case bounds on accuracy, or worst, like we can only argue about the worst case without lots of assumptions about the world. But we know we're not always going to be in the worst case. And as Josh mentioned, if we can just surface levers that can kind of help folks navigate this, at least we're bringing more awareness to how this can be used in other places, that hopefully can spur other creative thinkers to help iterate on this.
Can I ask one last question from the chat before we break? Okay, this is from Travis Liebert at UC Davis. So he wants to know, the dramatic rise of data communications apps like WhatsApp makes network communication data less and less informative for some analyses. How do these shifting communication platform trends change options or concerns related to data privacy?
Yeah, I think there's two answers. One is it partly just shifts the like most relevant data source, right? Like WhatsApp has their own like system for protecting privacy, but you know, you could imagine a framework that if we could guarantee the privacy of the WhatsApp data, that WhatsApp might be willing to share that privatized version of their data in order to facilitate the distribution of humanitarian aid or something like that. I think like more directly to Travis's point, the fact that like a lot of the communication is migrating into these app-based platforms doesn't mean that it's like degrading the accuracy of predictions necessarily, right? Like say you're only from Nitin's slide where you had that like silo of the mobile phone operator and you're not able to join it with the silo of WhatsApp. The mobile phone operator still sees the packets that are flowing, right? There's still a ton of metadata. And one thing that changed, remember I mentioned that Google Play Store policy change on what data could be surfaced. Basically, a lot of the app companies just migrated to different data sources. So instead of using data on social network structure, they really started to, or like, this was one thing that happened like 5 years ago, is they made it impossible for the app providers to access text message logs. So it used to be like 5 years ago that these app providers could actually get the contents of the text messages that you sent. And so back then they were relying very heavily on NLP methods to mine that text message content. But then when that data source went away, then they started looking at like Facebook activity and social network structure. And then when that data source went away, then they, you know, it's sort of like a set of dominoes. I don't foresee in the next near future that like this paradigm of using privatized data from private companies, private data from private companies would still be able to generate these credit scores. I think that's going to persist.
So thank you to Josh and Nitin for that. We're going to take a short break, about 15 minutes. We'll be back at 3:20 Pacific time for our last session of the afternoon.